Tim Boyle, the president and CEO of Columbia Sportswear, joins us now. Mr. Boyle, always nice to have you with us. You've been outspoken on this issue in the past. What are your expectations in terms of what it's going to mean for your business and others who sell apparel and footwear to the American consumer when these tariffs start to take effect September 1 and then others also on December 15th?
Certainly. Well, you know, our product commodities, both apparel and footwear, have been among the most heavily tariffed since the 30s. So we're very adept at operating in a tariffed environment. But this basically rogue application of tariffs coming at a very bad time in the United States is going to be really, really difficult to manage, especially when we really don't know what's going to be happening. So, you know, the president has put tariffs, additional tariffs on products which we're going to be importing from China and from other countries. And, you know, we're trying to manage how we distribute that product inside the U.S., how we divert it to other countries outside the U.S. You might remember Columbia's revenues are about 40% outside the U.S. So we have the opportunity to divert these things, and some product categories just won't be available for retailers. And then there's other product categories and product specific items which will, after the tariffs are imposed, be about 50% of the retail price paid by the consumer will be in tariff and tax.
Right. Mr. Boyle, what do you say to those who say, listen, somebody had to stand up to China at some point. They've taken many of our jobs. They steal our intellectual property. They don't treat our companies fairly in their home market. And in fact, if we're going to do it, now's not a bad time. The consumer remains strong. Yes, this is a tax, but it's one worth paying because it will enable us to get the leverage we need to get the Chinese to play fair.
Well, frankly, we've done business in China for 20 years, and for the intellectual property issues we've had in China have greatly diminished over the last several years. So I don't see the issues that the president talks about. I think it's easy to point fingers at a quote-unquote China as a big bad market, but frankly, it's a big market for us. It's one of the biggest geographic opportunities for our company, and I don't see why the Chinese consumer needs to be focused on as a bad person or a bad entity. We've had great relationships with China, and frankly, if you think about how the American consumer goods have been sourced since World War II, most inexpensive goods sourced for the U.S. market came from Japan right after the war. That production moved to Korea and to Taiwan when prices in Japan elevated. The same thing happened when prices elevated in Korea and Taiwan, moved to China. And it's difficult for us now to source product in China, not because necessarily the tariffs, but because the pricing there is at a disadvantage against other markets. Now, when we throw tariffs on, of course, there's a big focus on fleeing the Chinese market to other sources in Southeast Asia, including Vietnam, Indonesia, and others, and those prices are going up there. So ultimately, the consumer is going to be paying a significantly larger component of the cost of the goods that they buy in tariffs and in taxes. And there's elasticity in this product, as there is in everything. So we're going to see, you know, the risk of a reduction in revenues on these product commodities based on their pricing.
Well, that's what I wanted to ask you, Tim, is a lot of indications lately have told us the U.S. consumer is in great shape, including the second look at second quarter GDP this morning. Do you feel that you have the pricing power that consumers can actually weather a price increase as these tariffs go through?
Well, we will be raising prices on products to accommodate the tariff. We have prices built in for tariffs and have had, as I said, since the 30s. But the U.S. consumer is not an all strong, has tremendous strength. There's volatility there. And if they see that the business that they work for, if they're making John Deere tractors or if they're selling soybeans, or if they're a farmer, they don't have unlimited capacity to consume. And these people are fragile in many cases. So I don't think we can expect that the U.S. consumer has the unlimited ability to continue to buy products at any price.
Tim, you mentioned that looking elsewhere to source products in Asia is something that might incur higher costs too, simply because pricing has moved in those areas. The impression that given by some is that it's a relatively fluid process. In other words, not too difficult to reallocate manufacturing. What is your experience with that as a general matter? Is there capacity outside of China that could accommodate this type of activity?
Well, as I said, production for consumption in the U.S. has naturally moved to other countries over the last, call it, 10 years. This is not easy to do, to move these product categories. They're highly technical. They require significant investment in education for the employees making these products. There's structures around the engineering that go into the garments and the footwear. And then there's the raw material components that are required to build these garments. And you cannot just flip a switch and move these products around. There's other issues, including logistics of ports and roads that exist or don't exist in some of these markets. And to think we can just flip the switch and move it around is just ludicrous.
Yeah, but you do, obviously, as you pointed out, you manufacture in almost 20 different countries already. I mean, can't you just move some of the workload from China to other countries that are already producing similar products?
We've made moves over 10 years, but not in 5 minutes. It takes years to get these things up to speed. And now we've got competition from other brands and other suppliers that are running away from China to try and capture space that we've been using.
And what about the market in China for your products? Obviously, we've indicated you import to the United States from China, but you also are a major seller in China itself. How's the Chinese demand these days and the consumer there?
The Chinese market is growing more rapidly than the U.S. market, the economy. We've had a few challenges in China, mostly of our own making, but we think this is the biggest opportunity for the company. The biggest geographic opportunity is China.
So, totally separate topic, Tim. A few months ago, your big competitor, Patagonia, really cracked down on those popular corporate logo vests that we see all over Wall Street and Silicon Valley. Have you taken that as an opportunity? I mean, they were concerned about the values and environmental standards and all sorts of things of these companies. Is that something that you can pick up?
Well, we don't have the kind of thought process in terms of who we want to have wear our products. We're a very democratic company. We'd like to have everybody wearing our products, and individuals who have a particular political bent or particular economic bent, that's their own business. And if they want to wear our stuff, we'd love it. If they would rather not wear someone else's, that's okay too.
Right. And finally, have you cut investment, or are you cutting investment in some way as a result of perhaps trying to save on margin, getting prepared for the tariffs that are coming?
Well, here's what we're doing as it relates to investments. We focus on where the rule of law exists. And when we look across the globe, we're very concerned about the rule of law here in the U.S. and making investments that may be a waste of money for our investors.